I think the yield curve today is a very interesting shape, very unusual shape. We've seen for the last 2 years what's defined as an inverted yield curve, and that's where short rates are higher than long-term rates. It's typically indicative of a recession, and we've had it for a relatively long period of time. A more typical yield curve is a steep yield curve. Short-term rates are lower, long-term rates are higher. And that's more typical of a healthy economic environment. Today, what we see is what I would describe as a U-shaped yield curve, where short-term rates are high, rates drop in the 1 to 2 year maturity profile, and then invert into a more typical upward sloping curve. That's a relatively unusual shape, and there are very few instances, I think, and certainly a few sustained instances of that yield curve shape. And it creates some interesting dynamics and choices around how investors and issuers view the market. The fundamental issue is we have the market telling us that 2 and 3 years out, we should have a more typical yield curve shape of a steep curve. And what we're seeing on the short end is a Federal Reserve and a policy view that says we should have higher rates. I think what we're going to see over the next 3 months is one side or the other is going to prevail. That's either going to be the Fed reducing rates and creating a steep yield curve by the Fed, dropping short-term rates, or we're going to see a capitulation by the market, and we're going to see the whole yield curve shift upwards in the long end. The U-shaped curve creates a number of challenges in financing that is unique. First of all, staying floating is relatively expensive. No matter where one goes out on the curve, the floating cost of capital is still high. And perhaps one would want to bet on the fact that the Fed is going to capitulate and rates will fall and benefit from that decline in rates. But the reality right now from a company perspective is one can extend maturity and still reduce cost. That's a very unique position in the market and very beneficial to borrow longer term rather than shorter term. But that's at the short end. Where it becomes interesting is in the issuance when looking at the 5s and 10s year part of the curve. And what's interesting about it is that the benefit of being a 10-year investor is not as beneficial as being a 5-year part because they're not picking up a lot of yield for that extended duration. So when we look at recent order books, what we're seeing is investors making a position that is, I want to be in 5s and not in 10s, or I want to be in 10s and not in 5s, and taking a view on how they want to invest in that yield curve shape. And that's different from how most multi-tranche deals look from an order book perspective, where investors are typically pro rata. I'll take 50% in 5 and 50% in 10s.